Good morning, everyone. I will be giving you an update on the stable fund for the first quarter of 2023. Now, 2022 was a historically difficult year in the financial markets. Both bonds and equities delivered negative returns, and the traditional 60 portfolio had its worst year since the 1930s. Now, coming out of that terrible performance, it's no surprise that we've seen somewhat of a bounce back in the first quarter of 2023, with risk assets performing a bit better. But if you look at this on a one-year basis, you still see the majority of global assets, equities, bonds, property, delivering negative returns. So in that context, the performance of stable fund, protecting capital with a zero return while all other asset classes were losing money, was quite admirable, and an important driver being a big portion of the stable fund. On the local side, equities and bonds delivered positive returns but below cash, while property was negative. And the rand was on a one-year basis has depreciated quite significantly, which has aided the performance of international assets. So stable fund over the last year delivering a return of over 12%, while in a very difficult environment. I think we're glad we were able to deliver that performance for our investors through what continues to be a very volatile market environment. So what happened in the first quarter of 2023? The theme of inflation, interest rates, and slow growth has continued, and the question is whether we will see a soft landing or recession. I think this was an open question at the beginning of the year, but given recent developments, the Fed interest rate hikes are taking their toll. We've seen real estate come under severe pressure. We've seen the start of a US banking crisis, and we are tilting now towards more of a recessionary bias going into the second half of the year. Risk did rally in the first quarter because of the very tough negative performance of last year, and you found that global equities were up 7.9%, the JSE was up 5.2%, and the ALB delivered a positive return. Commodities came under a bit of pressure. There was a lot of excitement towards the end of the year about the China reopening trade, and the market does have the habit of taking excitement and turning it into pain. So those expectations were dashed, but we do think that China reopening trade and the potential positive performance can continue in the year ahead. And the dollar came under a bit of pressure as the banking crisis took hold and expectation of rate cuts coming through. So I think we have seen the peak of interest rate expectations, and we will see some easing going forward and as inflation moderates. In terms of performance, the one-year number of 12% is well ahead of inflation as well as the peers. And if you look at the periods over the longer term, the fund has delivered for clients over a period of time ahead of inflation and peers, and we hope to continue with that going forward. What has delivered performance in the shorter term as well as the 1 year? Global foreign assets have been a big contributor to performance on the back of very credible performance out of our global portfolios, where the Forward International Fund has protected capital. We've had a strong bias on our equity fund towards Asian equities, which have rebounded quite nicely. And our SA equities, Naspers, banks, Richmond and Hauser have all delivered very good performance, so stock picking has really come through nicely. We've also had some good performance on our bond component, where the belly of the curve has outperformed both the short end and the longer end. That's where we hold our fixed income exposure, and that's helped the fund over the last quarter as well as the last year. What have been some of the detractors? Some S&P hedges that we've had in place. We've seen a big rally in markets, but we do think that given the uncertain environment, it does make sense to have hedges in place and look to have some downside protection. But when the markets are strong, that does detract somewhat. But we still believe it's the right strategy going forward. So, what is the story of the market going forward? It's been a fight between the need for lower interest rates in order to support the economy and higher interest rates in terms of fighting inflation. And their market has ebbed and flows as the Fed has changed its position. We saw at the beginning of the year, we saw the market pricing in rates up to 5% and then a decline from there. But then the Fed got very aggressive in terms of its rhetoric, in terms of fighting inflation. In fact, just a few days before Silicon Valley Bank collapse, Powell testified before Congress, and he convinced the market that rates would be above 5.5%. Just a few days later, Silicon Valley Bank collapsed and the whole situation changed. And now, while the Fed is looking to continue to maintain rates at high levels, the market is looking for aggressive easing towards the end of the year and into next year. And that what the Fed ends up delivering will be a big driver of what happens with markets going forward. Now, we've seen a very significant banking crisis in the United States. You saw banks over the last few years load up on bonds at what were historically low interest rates. It was a tragic error on their behalf, and you can see that on the left-hand side, it's the holdings of treasuries that banks hold on their balance sheet, and that increased from under $1 trillion to $2.5 trillion in a very short space of time. And as interest rates have gone up aggressively, those bonds have lost money. As interest rates go up, the value of the bonds fall, and the unrealized losses on those securities are now over $600 billion. So if you look at bonds and loans, the total losses have effectively wiped out the bank's capital. And we haven't even started with the recession yet. So we haven't seen any credit losses coming through, and banks are already in a precarious position. So that tells you from a banking perspective, even with the bailouts that we've seen, banks will continue to suffer deposit flight because you're now seeing an alternative to the zero interest rates that the banks are offering. Banks got very used to very cheap funding on deposits because there wasn't really any alternative in terms of getting a yield over the last decade. The top slide shows you the interest rate that the banks are giving, which is just under 0.5%, versus the money market funds, which have gone from virtually 0 to 5% in just a year. And if you look at the gap between the money market and the bank interest rate, it's at a 20-year high. So there's a very strong incentive for people for bank accounts to pull out their money out of the banks and put into money market funds and get a much higher yield. So we're going to continue to see banks bleed deposits as they chase for higher yield, and until rates come down, they're hoping to get through this until rates come down. In which case, that deposit flight can abate. So the market is already pricing in a turn in interest rates going down over the course of the year. But that's in the medium term, we do see inflation and interest rates moderating. But over the medium term, we do think that inflation is going to be a problem for the foreseeable future, given the stickiness that we're seeing in the inflation market. We don't necessarily see inflation in the South Africa sticking back down to the midpoint of 4.5%, or the US inflation coming back down to 2%. We're seeing a recession being priced into the yield curve, and risk assets have rallied as they price in lower rates. But given the recent rally we've seen, we do advise caution because there is a rising risk of a credit crunch. If banks are losing deposits, they're not going to be able to lend, and there's the flow of credit into the economy will begin to dry up. So we have to be cautious and continue with our balanced approach going forward. What have been some of the bigger moves that we've seen over the last year? Firstly, we've reduced local equities and we've increased the foreign component, both equities as well as non-equity assets like credit assets, which have been offering a lot more value as interest rates have gone up a lot. We've also trimmed our SA bond exposure, and we've moved that into the money market area, which is a lot more attractive going forward. Money market rates were down at 4.5%, but over the last week, we've been buying into one-year assets yielding us over 9.2%, which is very competitive relative to bonds. So it makes sense to allocate some of that bond allocation into the money market. So those are some of the bigger moves that we've seen over the last year. Physical gold has done phenomenally well as the market looks through the high rates in the US towards rate cuts at the year end. And we do think it's an important part of the portfolio, given the big downside risks and the large amount of debt in the system and the potential for monetary easing later on in the year. Another big event in line with the banking crisis was the write-off of subordinated debt. Both Silicon Valley Bank and the massive $17 billion write-off in terms of Credit Suisse as they were taken over by UBS as well as the government. So you saw their subordinated debt went from 100 to 0 in a very short space of time, and it highlighted the risk of subordinated debt. And the spreads you're getting don't compensate you for that risk. So therefore, we believe that having a very high credit quality in our portfolio and no subordinated debt is very important going forward. And also, just to highlight how challenged the SA outlook is, this slide just shows you the number of days of load shedding that we've had from 2020, 21 and 22. And you can see now for this year, every single day has been a day of load shedding. So this is a massive headwind for the economy. If we can't deliver electricity, it's very difficult for the economy to grow. And that's why you're seeing even the SARB reducing its growth expectations for this year below 1%. So summing up, higher rates are taking their tolls on the housing market, the commercial real estate market, and now the banking sector. There is a demand for higher rates from sticky inflation, but we do see the risks of a recession which demand lower rates. And the SA economy does remain structurally challenged with the political environment and the power issues. So equity selection is critical, and in the stable fund, it's important to have equities in the fund which have minimal downside risk, and that's what we focus on there. SA bonds are reasonable value. We still have the component, but as I mentioned, we have shifted some of that into the money market now that it's offering good value, and we have shifted into inflation-linked bonds over the last quarter as they become attractive. Gold is an attractive diversifier, but at the end of the day, the most important thing is to have a diversified pool of assets which can deliver you inflation-beating outcomes. Thank you. So SVB had a massive pool. Almost half its balance sheet was hold-to-maturity assets. In South Africa, the banks do dabble a bit with holding government bonds where they can have a positive carry and having a portion of hold-to-maturity assets, but it's a lot smaller component. The unrealized losses on the banking sector are less than 1% of their capital. So while they do that on the margin, it's nowhere near the effect of what banks do in the US. So subordinated debt has taken a massive loss. You see in the case of Credit Suisse, $17 billion of write-off. I think that it has highlighted the risks in this market, but interestingly enough, in the local market, we haven't yet seen an impact. I think local investors, the chase for yield is still very strong. There's a lack of supply in the credit market, and spreads are at extremely compressed levels. So while in the rest of the world, subordinated debt has been selling off, Tier 1 debt is down 10 or 15%, and banks overseas are struggling to come up with a plan for how they're going to issue this type of asset class going forward. In the local market, you're actually seeing continued demand for subordinated debt. However, any asset which can have a complete write-off in capital, I think has to be priced correctly. And in the South African market, that downside risk is not priced. Therefore, we believe it's one to avoid. And if you still continue to hold it, we think there's an opportunity to get out because the pricing is still at the same levels and there is still demand in the market. So gold has had a phenomenal quarter. It's finally provided its diversification potential, and there's been a lot of talk while gold has been performing about the decline of the dollar and what could be the replacement, gold or maybe even the Chinese yuan. Now, firstly, I think that the Chinese yuan is not a potential replacement for the dollar because at the end of the day, it's actually pegged to the dollar. It's a fixed currency where the Chinese central bank controls it within a tight band. It's also not an open currency, so there's tight capital controls, and you can't have a fixed currency with capital controls being the potential replacement for the dollar. So I think that in an environment where the US has declined in importance in terms of the global economy, at one stage the US was 50% of the global economy, it's now down to 25%, the dollar doesn't necessarily need to be 90% of all transactions. And maybe going forward, if you don't have this globally dominant economy, we maybe don't go back to a point where you have a single reserve currency, but maybe multiple floating currencies, which we have to be aware of. And in that type of environment, gold's importance as a central store of value and a central reference point for valuation could be quite important than it has been over the last decade. The energy crisis is a massive problem and has limited our growth for a number of years, and it has gotten to the point where the ANC has now finally woken up, if only to improve their election prospects for next year. Last week I attended the SA Investment Conference, and I think I listened to Cyril Ramaphosa speak, and his half-an-hour speech, the first 15 minutes, he only talked about the power crisis. So I think it's really hit home that without power, you don't have an economy, and there is a big drive to fix that. But it is going to take time. You will get some relief from some plants reopening towards the end of the year, but load shedding and looking for alternative sources of power are going to be something that South Africans have to get used to in the coming years to be able to self-provide. So we don't think it's going to go away, and it will be a headwind for a number of years. But I think we are in that worst point for the next 6 months.